In this video, we'll discuss the progressive tax system. Now before we begin taxes, let's talk about income. You have a gross income, which is your income before taxes and deductions. That's often what your contract is signed with. Whereas you have a net income, which is what you actually bring home after taxes and deductions. So when you're calculating taxes, you're doing that on the gross income. Now we have two common types of income systems that are talked about, the flat tax and the progressive tax. In the United States, we have a progressive tax system. So let's compare it to one of the more common flat taxes. In a flat tax system, your gross income is taxed at a given rate, the entire income. Whereas in a progressive tax system, it takes your income and splits it into small portions that are then taxed at progressively higher rates. Now, with the progressive tax system, there's some key understandings. First, it will always collect the same or less taxes than a flat tax system. The only time that they are the same is when you are in the lowest tax bracket of the progressive tax system. Otherwise, the progressive tax system will actually take less in taxes. Also, if you get a raise, it doesn't make you get less money because you're being taxed at a higher tax bracket. That tax bracket will only tax the very top part of your income. So it's a very small portion that may get a little bit higher rate. So you always want to take a raise because in the end, you are making more money. And lastly, there are 4 different tax brackets that actually exist in the United States currently. These are when people file single, when they file jointly married, when they file separately married, and when they can take the head of household. And you should talk to a financial advisor to determine what's the most appropriate one for your situation. Now let's compare the flat tax to the progressive tax for a single filer. On the right, we have what is the current tax brackets in the United States. And say that Shay earned $50,000, and we know what would Shay pay in a flat tax system. This is where we take their gross income and just multiply it by whatever tax bracket Shay would be in. In this case, it would be the 22% group because that's where $50,000 falls. So we take $50,000, multiply it by 22%, and you can see we have it written as a decimal so we can actually calculate it, and that would be $11,000. So in a flat tax system, Shay would pay $11,000 in taxes. Let's compare that to the United States progressive tax system. So here, we're going to take that same income, but we're splitting it up based on the tax brackets and paying a little bit higher rate as the income goes along. So we start at the lowest tax bracket, and we're going to pay taxes on the first $9,950, and we're paying 10% on that. Then we go to the next tax bracket and say, okay, $50,000 is greater than this, so we're going to use this entire tax bracket. So we take the upper value, subtract the lower value, and then multiply it by the tax rate. Now we go to the next one. So you can see we've gone from one portion being at 10%, the next portion being at 12%, and now we're going to jump up to that 22%. And that's only going to go up now until we get to $50,000. So for this, we go to our maximum gross income, subtract the lower entry in that tax bracket, and multiply it by our tax rate. Now let's simplify this. So we'll have $995 plus $3,668.88 plus the $1,996.28. We add these three values together and we'll see that Shay will pay $6,660.13 in the progressive tax system. So let's compare those two. In the flat tax, Shay would have paid $11,000. In the progressive tax system, Shay would pay $6,660.13. That means that because we're in this progressive system, Shay is paying $4,339.87 less than if it had been a flat tax system. Now, we're leaving out one important thing that happens in the United States, which are deductions. And there are 2 forms of deductions that happen in the United States. There's the standard and the itemized. The standard deduction takes a fixed amount automatically from the gross income before taxes are calculated. That standard amount changes based on whether you're filing single, jointly, separately, or head of household. whereas the itemized deduction allows you to take certain financial items such as like your mortgage payment interest and subtract that from the gross income. In the United States, you have a choice between these two, although most will file standard because they can't get enough itemized items to be more than that standard deduction. Now let's look at an example with Shay taking the standard deduction of $12,950. So what this means is the first thing Shay would do is subtract the standard deduction from the income. That means we're really paying taxes on $30,050, not $50,000. So that changes as we go through the progressive system. We still have that first bracket of 10%, and that will be the $9,950 times the 10%. But we think about it, $37,050 only falls in the 12% bracket. So we're going to take the $37,050 and subtract the lower end of that tax bracket, the $9,951, and multiply that by the 12%. And when we add those values together, we get that Shay would be paying $4,246.88 in taxes with the standard deduction. So that standard deduction just saves Shay over $2,000 in taxes.